Alright, and we're back again with another valuation. This time we're going to talk about ITT Educational Services Inc. Ticker sign ESI, also known as ITT Tech. If you live in a major metropolitan area, you've more than likely seen their commercials out there about going there and learning about criminal justice or cybersecurity or any other technological or electronic field or drafting courses, and you can go to their school and get an associate's, bachelor's, master's degree in these various fields, and then go out there and use that credential to increase your marketability as a worker in the workforce. So the controversy surrounding these companies lately has been, are their services valuable, and are they just scamming these young people out of their money, and they're not actually gaining any skill set that's going to help them with their employment chances. That's a major controversy out there. I don't really want to get into that. I want to look at this more as an investment and see how it would be to invest in a company like that. That will come into play later, but for now we're going to focus on how well they do as a business. And what is their business? Their business is to sell the idea to young people that if you come and you pay us tuition and you sit through our classes and you pass everything, we are going to give you a piece of paper, and you are going to be able to tell your employer or your future employer that you have the skill sets to work for them and do a good job and be a productive member of their workforce. So that's their plan. They're offering education. They're offering degrees for profit. So their major competition obviously is going to be the non-profit universities and colleges that are out there. That's going to be a big part of it, and also those other for-profit companies out there, University of Phoenix, which is the Apollo Group, Everest University, and there's a whole bunch of them out there. But ITT Tech's been around since the 40s, and they focused on these hands-on, almost vocational type courses. Not vocational in the auto mechanic type world that we usually think of as vocational schools, but similar type hands-on training type courses out there. And they've been successful at that for decades. They've been around for a long time. Lately, however, they've just been crushed, and they've been crushed for various reasons that we'll go into here in the video. So first off, let's take a look at them just purely as a business. Then we'll talk about the qualitative aspects of the company. If you look here at this chart real quick, this is without me messing around with it. You can see here that it's really taken a nosedive since the 2008 era. It's just tanked, and it's gone all the way back down to where it was in the 2002 era. So it's lost all of its gains over the last 10 years, and it's just been crushed lately. So is now a good time? Is this a value play, or is this a value trap? Let's find out. So the first thing, let's go to the charts, because it seems that everybody likes the charts more than actually looking at the financial statements. Let's look at free cash flow. How's free cash flow been doing? Pretty steady. 100 million, just slowly grow, and then we hit this explosion in 2009, 2010. Just really kicked into gear, and then it just came promptly right back down. So it looks like they had a nice run of a lot of students coming in, and then all of a sudden it just went downhill really quick. And that may make sense given this time frame. In 2008, 2009, there was a lot of people unemployed. Some people say there's still a lot of people unemployed, but a lot of people went back to school to re-educate themselves so that they could get another job. So if more people are going for additional education, ITT Tech's obviously going to benefit from that, and this is going to rise significantly. Free cash flow will, because obviously sales will grow. Owner's earnings, how did that do? A little different than free cash flow. It grew, and then it kind of stayed up there. It kind of stayed up in this 400 million range right here, whereas free cash flow dropped down to this 104 million lately in the last year. So owner's earnings has actually gone up and then stayed up there. So this was an interesting contrast between free cash flow versus owner's earnings, and how different those numbers can be in a business. So what's the stock price done? It's just been hammered. It's gone up all the way up into the hundreds. 140 I think is the high that I saw, all the way back down to the $12 range where it is today. Earnings per share steady climb, big jump, and then it just tanked in the last year. So is this a blip, or are we going to see more of this to come? Here's some quick ratios here. Free cash flow to sales, price to free cash flow. Look at this, 46 times free cash flow here, and it's just tanked all the way down. Now in the trailing 12 months, 2.9 times free cash flow is what you're paying for now. So obviously the market thinks that there's not a whole lot of future here. Keep going down. Free cash flow yield, 34% lately, and that's just steadily climbing. Cash return on invested capital. This chart's kind of deceiving because it's very high, very big differences here. Negative cash return, negative cash return, negative cash return, and then all of a sudden it jumps to 497%, and then 9,000%. This chart doesn't really tell us a whole lot. There's a lot of volatility out there, I guess, is the best thing that we can get out of that. Return on assets, that's pretty steady. Again, it looks like follows the same curve, but that's actually fairly high for return on assets, even 16% at the lows. But even going up into the 20% range here, that's pretty good return on assets. Return on equity is just ridiculous. Here you get in the 40%, and then you're up over 100, almost 300% return on equity. So return on equity is extremely high in this business. You don't need a lot of equity in there to run this. So either they're goosing this equity with debt, or they have incredibly high return on their services. There's not a lot of assets that they need to generate the cash flow that they generate. It's not a manufacturing business where you need those assets. It's a service business, so return on equity should be higher, kind of like Coach was, just managing the brand. You don't need the factory for them to operate. Even in this case, it's even more pronounced. You just really need some office space, and you can just churn students through it. I hate to say that because that's one of the controversies around, but students can just flow through the same assets over and over again. You don't need to reload on the assets, so you can use assets over and over again and get a significantly higher return. Okay, gross margin. Gross margin is pretty steady, slightly increasing. I like to see that. Net profit margin was steadily increasing, then it came back down to earth here in the last year. So that's a concern. The quick ratio, they had a lot of cash in 2003 compared to their liabilities, and that's slowly coming down back to earth. It's now 2.8. That's still pretty good. Having a quick ratio of 2.8 is well within safety range. So I'm not concerned about this as much because it's coming from such a high point. It's got to come down a little bit. It just has to eventually. So worrying about that is I think not a big deal. Current ratio, same thing. It was up here in the 5s and it got really high. It's still well above 3, so I'm not really concerned about that either. We look at inventory turnover right here. That's really irrelevant. They don't have any inventory to speak of because they don't sell assets to anybody. Debt to equity. This is always one of my favorites. This is a concern. Look at the debt to equity, 148.6% debt to equity. So this is a fairly highly levered company. Now, is that as much a concern as usual? I'm not so sure. I think because of the fact that they just don't have an asset base in their business, it's a service business, you're going to see debt be a lot higher than equity than in most businesses because equity is just such a small portion of it. There's not a lot of assets out there to finance that you can use a lot more debt, or the debt load you have is going to be a lot higher because of it. Even though the business may be massive, if there's no assets there and you're just churning cash through it constantly, you're just churning these services through it, and cash is coming in, cash is coming out to the shareholders, you can have a lot more debt than equity because the asset base is in there. It's just kind of not a reflective metric to see how the balance sheet looks there. But it's still a little bit of a concern. I don't like to see debt at all on a balance sheet, so this is going to be a little bit of concern. We'll dig into that a little bit more. However, here if we look at free cash flow debt, as I was talking about, 80.8, 100%. Their free cash flow more than compensates for their total debt. They have cash just coming through this company all the time to finance the debt. The debt is being serviced more than adequately here. So there's not a lot of concern. If you look here in even 2010, they got 368% of total debt was financed by free cash flow. They could have paid off their debt load almost 3.5 times over and still been fine. And even in 2012, 74.5%. They have more than enough cash flow coming through to cover their debt load. Another thing, free cash flow to short-term debt. They don't have any short-term debt. That's good. There's nothing coming due in the near term, so we're pretty safe in that regard. Free cash flow to long-term debt. Obviously, it's going to be your free cash flow to total debt because all their debt is in long-term debt. So you can see here it's the same story. All of it's long-term debt, which is good, which means that we're not in any immediate danger of having a financial crunch. A lot of it's long-term. So those are the charts. Let's go through the statements real quick. Again, we'll start with the balance sheet as usual. They do have a significant amount of cash, $246 million out there. I get confused here a lot of times. I see this 2012 and I immediately compare these two. But they're usually a blend of one another, or in this case they match completely. So be careful of that when you're looking through these. They do have some buildings and improvement and some land. These are the places where they teach, the office buildings that they have their courses in, or wherever they're having the facilities. This is they own those buildings in a lot of cases. They do lease some of them as well, but you can see here that they do have a nice real estate base out there in the business model. So we own some property too in here, so that may be a hidden gem in this whole thing. Machinery and furniture and equipment. So they have a lot of stuff out there, a lot of technical equipment out there to teach these courses that are not your traditional bring a textbook and we're going to draw on a blackboard type courses. It's a lot of hands-on stuff. So you're going to see a lot of special equipment that's going to be needed to teach these courses, and that's what a lot of this machinery, furniture, and equipment is. Special computers, maybe some electronics equipment, things that are outside of my sphere of influence and learning. Maybe some special drafting equipment that's out there. Chairs, desks, and all that fun stuff as well. And they have some other assets out there as well. It doesn't look too significant to us. Then we look at their debt load. Again, I said they have a very large debt load to their asset base, and you can see here it's pretty significant. $560 million, $545 million compared to their asset base here of 728 and 767. This is a concern that this went down a little bit, but they have a pretty large debt load compared to what they have on their books for their assets. Now keep in mind their assets, they've been around since the 1940s, so some of these maybe on the books are significantly less than what they are. I haven't dug that far in to see what their asset base is, so this building and improvements number could just be significantly diminished from the true market value of that real estate. Same with the land here. You can see a lot of it came back then. Well, they've acquired some of it recently, but so we don't know what this market value is. But going back to the liabilities here, it is significantly higher than I like to see in any company's books. But when we look at the debt load here, their long-term debt, this is really like a revolving credit facility that they're kind of maxing out here, and it seems like it's just stable. It's just sitting there, that they're kind of spinning through this long-term credit facility that they have out there, and they seem to be doing that rather well. It's just sitting on the books out there. They're not really having to pay it down or anything, and that's continued into 2012. Looks like they paid down about $10 million, but it's nothing that is increasing or decreasing. It just kind of is there. So I'm not as concerned about this. It is still a liability they're going to owe, so I am kind of worried about that. I'm also worried about these other liabilities. And these could be contingencies for some of the legal issues that we have. We'll talk about in the qualitative area, and some of those liabilities that they may have to owe in the future. And there's a lot of controversy. This is one of the reasons that they're having such troubles as of late, because of these other types of liabilities. Another big debt that they have is deferred revenue. This, I can't even really count this as debt. It's a service that they owe. Yes, it is a debt. It is something that they owe to somebody else, but it's not a cash debt. This is something where they have gotten prepaid tuition